Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at Caesars Entertainment Incorporated, ticker CZR, the casino chain. About once a week, I go to a Caesars casino, and next week I'm gonna travel, stay at one of their casinos. I really like their rewards program, and it's just a fun time, so I wanted to check in on the stock and see how the stock's doing, and if it'd be reasonable to purchase. That way, if I lose any money while I'm gambling, at least it shows up as a profit for them. I've got a few things graphed out here. The technicals here are pretty interesting, but fundamentally, fair value coming up with right around $50, which seems to be almost, at least back in 2019, was the ceiling. It broke above coming out of COVID, like most stocks did, and then came crashing back down as interest rates rose, discretionary spending dropped. This year, they're not expecting the best year out of them, but to go from 120 down to almost 30, cut down to a quarter of its size, it's definitely a stock that hits my radar just for that alone. It seems to have a really strong floor right here around $31. You see, it got above it in 2018, came down, touched it. Of course, it broke below during COVID, and even the pullback after that bounced right back off of it, and again back in 2022. So that is where it looks like it's heading right now. I would not be surprised if in the next few weeks or months this thing gets down to around $30, and ideally I'd like to be buying it around 25, 26. And that is factoring a larger margin of safety into the stock because of the growth that is expected over the next 2 years. And then we have the numbers. Like I said, the fair value, $49, $50, somewhere in there. Margin of safety of 45% because, I mean, at least with this initial thesis, we're only looking at 5.5% growth. Not awful, no dividend or anything. Do have a feeling that these numbers are being compressed by analyst expectations for this year, because this year is not expected to be very good. So we'll have to come up with something better for the 3 to 5 year time frame. As for the ranges that the stock has actually traded over the last 52 weeks, currently it's around $35. The lowest it's been just shy of $35, and it's gone as high as 60. Earnings yield, little low, not expecting much out of this year. Last year was 355. The year before that, 365. They had some really bad years for COVID, and this year is not expected to be anything amazing. And even next year is only expected to be 178. So definitely a stock on the recovery. And if we go back to 365 in 2022, this is the same year the stock price hit the hundreds. I think it was really overvalued at that point. Even then, I'm only coming up with $50 for the fair value. Cash flows kind of low. I mean, not a huge surprise here. I mean, they have a lot of money that comes in and out. They rent a lot of their properties from Vici, at least in Vegas, and they only have a 2% edge on a lot of the games. Hotels, restaurants are probably where they're making their larger margins, and their gross margin looks really good. So that's clear there. They do get a lot from their hotels and restaurants and probably shows, venues. They do not pay a dividend. Don't really blame them for that based on their business model. ROE, really high, super high debt to equity ratio, likely due to any buildings that they do own and not rent. We can somewhat give them a pass for that. I mean, it's a yellow flag more than a red flag due to the nature of their business. ROI, not good. Losing just a little bit of money. And ROA, very small. Gross profits, again, nice in the 50s. Net, they came in almost at 7% this last year. I'd like to see that get above 10, but we'll see how things go moving forward. I think a huge boost to them is going to be as more states legalize sports gambling. For example, Missouri, it's not legal. They're talking about legalizing it. But of course, there's a massive advantage to the house in sports gambling. in facilitating. They don't need to lose any money. Every single game could be profit for them. And they already have the infrastructure and other portions of the business that they don't need to advertise super heavy. We looked at DraftKings the other day. Their expenses are just way too high. Otherwise, it'd be decent. Revenues, 3-year CAGR, 6%, and then just shy of 2 in the 2-year. In the 1-year, negative. Analysts are projecting 1.3% growth this next year and 2.84% growth the following. Compound annual growth rate of 2.84 over the next 2 years. I have 2.6. I think that they can do better than that, but we'll stick with this to start. Cash flow growth. I mean, their cash flows, we can take a look and see if there's any consistency. 2021, of course, was a poor year. Not really any consistency. If we were to take 2021 as an outlier, we'd be looking for 2023 to be up here above 500, closer to the 600. So I'm not seeing a whole lot of consistency here, but it is pretty well within a range, 300 to 500. I know it peaked up a little bit in 2022, but they did come in with a higher yield than average this last year, and I do want to see them continue to grow that. So if we put 3% just over the revenue growth, that'll give them a little bit of growth. It'd take that 3.75 to 3.8 over 5 years. So nothing crazy there. Share count, barely issuing shares. I really would like to see them buying them back, but we're not right now. So we're going to go with 0.4, just in line with what they have been doing. Assets, they're shrinking. Not super fast. I mean, just a very small decline in the last 1 year. 2 years, around 4%. So we're going to go with 3, something lower than their 2-year. They are slowing it down, clearly. But we'd really like to see those growing. And they did just open a new casino in Nebraska. I'm sure that we'll see an impact on the balance sheet from that for both the assets and the liabilities. Liabilities are shrinking faster, 3.8, 5%. So we're going to go 4.5, kind of the midpoint between those. And the margins, I would really like to see the margins grow. Like I said, 10% would be ideal. 1.2% gets them up to over 7% in 5 years. So again, this is a very small, generous, this year's a bad year example, in my opinion. And that would give a average return of about 5.5% in the fair value, or average growth of 5.5% in the fair value. And in 3 years, we'd be looking at a share price of around $54, which would grow to $57 in the next 5 years. So buying at today's price of $35, you'd be doubling the market returns in the 3-year, outperforming pretty well, but not doubling in the 5-year. And if this thing somehow decides to run back to the $100 range, personally, I would get out at that point. I'd probably get out in the 70s based on what I'm seeing, but be sitting pretty well on that. So let's try to come up with something a bit more generous. What would give us market returns? This is the real question here. I really want them to fix these margins. So if we go 1.5%, no. Well, there we go. I found the biggest impact is the balance sheet. If they can grow their assets instead of shrinking them while continuing to shrink their liabilities, they'll be in great shape. Because we had this at negative 3%. If I took it to just a small growth of 0.5%, then all of a sudden we hopped from 5.5% per year growth in the fair value to almost 14.5%. And even if this is negative, what they came in with last year, we're getting market outperformance there. I tweaked the margin a little bit, got it up to 8.13. That really didn't have much of an impact. And the revenues, I jumped to 3%, which, again, didn't have too much of an impact either. If we cut this back down to 2.75, you see 0.05%. So the story here is going to be the balance sheet. If they can get enough cash flow to pay down their debts and grow their assets, I know that this is a stock that I'm personally going to want to be buying if I can get it for the right price. Like I said, under 30. I'll probably sell a cash covered put at $30 and collect any money that I get through premiums, and I wouldn't mind assignment at that point. See where the stock goes from there. If we want to take a quick look at the valuations, earnings were negative back in the COVID era, of course. Hopped up to some nice positive numbers, 2022 and 2023. This year is expected to be essentially nothing, and then next year they're looking to come back to half of what they did 2022 and 2023. So the earnings, for the most part, are the smallest factor here. And when we look at the actual share price, is there anything that we could say is correlated to it? I mean, it was at a good point in 2020, kind of in the middle of everything if you take out the earnings. Ran up way above everything else. There was nothing else that went up along with the share price. In fact, fair value and cash flows went down. The earnings did make a bit of a move towards the upside, but they were still negative. And then everything got super tight in both 2022 and 2023. In fact, I can't even really tell where everything is at in 2022. Looked to be a little undervalued this last year, and now it's definitely undervalued with where it's at. So we've identified an undervalued stock that had a huge pullback, and those are two factors that I like to see, and then it depends on what you have for your thesis here. If you think that the original thesis is going to be true and you're only going to make 5.5% per year, personally, I feel like that's a little low. I feel like this one is a bit more reasonable, but I'd really like to see them fix that balance sheet and start buying back shares, and then this will be a really good. So I want to thank you guys for watching. Please like and enjoy the video, comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.